Hey, what's going on, everyone? Welcome to another video. Do you want to turn $500 into $2,500, $5,000? Today, I'm going to cover an option strategy that if you do this consistently over time, you will be able to make those kinds of returns. I can't guarantee that it'll happen in a year. I can't guarantee in 2 years, but if you have a small account and you're looking to grow into a larger account, these option strategies will allow you to get there. If you're new to the channel, I would greatly appreciate it if you could like and subscribe. Feel free to check out the links down below for some awesome resources. I've used them to learn a lot more about options, option strategies, how to do them. I'm going to walk through a few stock examples today with companies' stock prices varying from $60 all the way up to $480, $460. So definitely stay tuned for the variety of examples. So Shopify, I'm going to start with Shopify today. And I'm on Robinhood. I think this platform is just easiest to walk through given the user interface is great, but you can definitely trade options and do options on any other platform. So I'm going to click Trade Shop Options on the bottom right. And now Robinhood's going to populate this preset option table. So what you're going to do is you're going to do a few things. One, you're going to need to determine what time frame you want to trade this option. So if you're selling a put, let's just start with that example. You need to decide, do you want to sell a put that is open for 1 week, or do you want to sell a put 1 month out? So for this example, I'm going to do August 18th, so about 24 days out, and I'm going to go sell put. So now you may be asking, what's happening here? What's going on? So let me walk you through it. So what you're doing here is you're selecting 65 put and you're selling one option. Now remember, one option contract consists of 100 shares. So by selling a put, you are effectively saying, if Shopify goes below this price, I will purchase it. Let's just assume that. I will purchase it. And in order to do that, someone's paying you $420 today to open this contract. So someone's buying it, you're selling it. If you're selling it, they have the right to put you 100 shares at 65. So let's say 24 days from now, if Shopify is 60, you have to purchase Shopify for 65. So that's going to be a 5-point loss already off the bat, just owning Shopify outright. But the amazing thing with cash secured puts is if you want to purchase 100 shares of a stock anyways, you could sell a put against whatever stock it is, collect this income in the meantime, and lower your potential cost basis as you continue to sell these cash secured puts. So with this super aggressive example at 65, given Shopify is currently trading at roughly 65, you could collect $420 today and effectively lower your cost basis by almost 4 points. So if you were to put Shopify at 65, you would then own it in theory for $61 as your cost basis. So cash secured puts are amazing if you're looking to purchase stocks anyways. It's an amazing way to create additional, simple, easy passive income. Now, I'll show you an example of what a cash secured put looks like a little bit more conservative. So let's look at the 60. I'm going to look at the delta, it's 0.28, so it's a little high. Let's go all the way down to 55. So at the Shopify cash secured put, strike price of $55 for 24 days out, the delta is 0.14. So that roughly means the option will expire in the money below, 55 or below, roughly 14% of the time. Implied volatility is higher, that's great. That helps with the option premium. If you select this option, you could sell a 55 put and collect $86 today. So if you're putting $5,500 of collateral, that's over 1.5% returns. Nothing crazy, but if you annualize that, that's when it really starts to compound. Now you may be thinking, well, I don't have $5,000, $6,000 to sell a cash secured put. That's totally fine. I'll walk you through the put credit spread, and I've shown this example so many times. It's an amazing strategy, and I can't recommend it enough. This strategy is going to consist of two options. One, you're going to be selling a put, and then two, you're going to be buying a put a leg lower. So in this example, I'm going to sell the 60 put. I'm going to collect $200, but now I'm going to protect myself by buying one leg lower. So now I'm going to go to the 55, and what this is doing, this is effectively protecting me, where I'm making this credit I'm paying this debit, so my total credit is actually $118. So the amount of capital I'm actually risking in this kind of scenario is only $500. It's truly the spread between these two strike prices. Like I mentioned in other videos, you have to determine what strikes, what stocks, what type of premiums you're looking for that work best given your risk to reward profile. But in my view, this is over a 20% return, not too bad. Given you would collect $1 per share of one contract, $118 for putting up $500 of collateral. So that's over a 20% return, not too bad, assuming Shopify stays above this $68 put strike price. Jumping over to Nvidia. So now Nvidia is a monster in the tech semiconductor AI space. I'm sure you've seen it in the news lately. 1.13 trillion market cap, PE ratio of 231, so pretty high. And Nvidia's had this massive run up over 170% in the past year. In the past 3 months, up over 70%. So I'm going to walk through simple option strategies you can trade on Nvidia, given the massive run up. I'll quickly walk through some assumptions around that. So given the massive run up, I'm going to sell or trade a call credit spread. So I'm kind of assuming Nvidia's had a massive run up. It must cool down. Now, if you're extremely bullish, then this is not the strategy to do. But I'm going to assume it's had a massive run up. It's going to cool off, but I'm still going to be fairly conservative with the strike prices I'm going to choose for this example. So I'm going to select the 515 here just to show you what kind of scenarios could be. And then I'm going to do one leg higher. So I'm buying the 440. So I'm selling the 515 call, and then I'm buying the 520 call. So now I'm opening what's called a call credit spread. So similar to the put credit spread, like I've mentioned in other videos, but the other direction. This is a 5-point spread. Now here the total credit is $50. And that's a 10% return. If you do this 10 times, just think about how much that could compound over and over and over again. Again, this may not seem like a massive credit to be earning, but if you think about it from a percent standpoint and annualize that, that's amazing. You have to look into, what strike prices make sense. Are you extremely bullish? Are you extremely bearish? And overall, what's the market sentiment? The last stock I'm going to cover has had a similar run up to Nvidia, but operates in a different business model, whereas Meta, Facebook, generates revenue and profits based off advertisements. I have a more bullish view on Meta, so I'm going to walk through similar example to what I did for Shopify. So taking a look at Meta, I'm going to select the expiration date that I want to look at. I'm going to sell a put. Now, I could sell a put if I was willing to purchase Meta and collect some simple passive income in the meantime. If I want to sell a put all the way, let's say $250, I could collect $272 today for selling this put. So in theory, what's happening here is if Meta stays above $250, this option will expire worthless. The $272 stays in my account, and then I can just sell an option, sell a cash secured put on any other stock I want to. To me, this isn't too bad, given this is a 1% return roughly on the amount of capital you'd have to put up. But note, you'd have to put up a significant amount of capital, almost $25,000 for this cash secured put. $25,000 is going to be a lot for a lot of investors. If you don't want to do a cash secured put, you could do the put credit spread. So you could now add a second leg lower, and now you could have a total credit of $55, and you'd be putting up $500 of collateral for this option. So this is the exact same type of trade and setup that you could do for Shopify, given you're more bullish on the stock, and you think in the near term it's going to continue this upward momentum and upward trajectory. Now, if you want to be a little bit more aggressive, I can quickly show you what some of the premiums will look like. Let's say 275, roughly 25 points lower than where Meta is currently trading. It's almost 10% lower than where it's currently trading. You could sell a put. You can collect some pretty decent money. Granted, you'd have to put up a significant amount of capital, but from a percent standpoint, that's not too bad. But if you want to do a put credit spread, you can buy a leg lower. In here, you would get a total credit of 135. You'll notice the bid-ask spread is a little bit off given the market's closed, so just keep that in mind of why these numbers aren't perfectly matching. So this is over a 25% return if you were to select these strike prices on Meta at this time. If you found value in the video, I would love it if you could like and subscribe. And again, comment down below any stocks or other options you want me to cover. Also, let me know any success you've had over the past couple of months. I'd love to hear it. Hope you have an awesome one, and I'll see you in the next video.